Everyone. I'm a first year finance student, and today we're going to cover a few basic finance interview questions. So I have these questions in front of me, and I haven't really looked at them yet, but hopefully I'll be able to answer them. And if not, I'll say I don't know, and we'll answer what the answer should be in part two of this many part series. I say many part series because finance interviews are very broad, so therefore we'll probably have to cover it through multiple chapters. Now, the first question is, how do you value a company? Now, there's different valuation methodologies. It falls into two separate categories. One is intrinsic valuation, where it's based on how a company is valued based on its own strength. And then there's also relative valuation, where a company is valued relative to how it performs compared to a peer set of companies. And peer set of companies is just companies that are comparable, that are similar, and therefore should have a similar valuation methodology. Now, and on the intrinsic side, the most common is discounted cash flows or DCF analysis, where future cash flows or dividends is discounted back to present value to see how much you should pay now for those future set of cash flows. A second methodology on the comparable side would be trading comps. So, based on common indicators like price to earnings or EV over EBITDA, you find out how another company, say for example, you have a company making widgets. It makes $10 a year in earnings, and it's currently valued at $50. So therefore, people are paying $5 for each dollar of earnings that it sells. Now, if you have a very similar company, but with $5 of earnings selling widgets, same scale, same proportionality, then you would expect the pricing of $25, keeping that same 5 times price to 5 times price to earnings ratio, because the only difference is the size of the company is doubled. Now, the main advantage of this is that it's very quick and easy. It's based on reality of what other companies are trading at. The downside is that if the companies aren't very comparable, then this comparison doesn't work, because if, for example, one company has better management or better costs or better growth prospects or has certain competitive advantages that other companies don't have that aren't fully realized in their current, say, earnings, for example, then the multiple that's being applied to is applied to a base that isn't as relevant. There's also transaction analysis, where we look at how much similar companies have been bought for or sold for in the past. And this also implies a control premium in that it's real transactions, so not just what the market's currently trading it at, but also what actual takeovers have happened at. So it's good for takeover analysis, for example. Now, the upside of this is that it looks at real transactions, and the downside is that sometimes there might not be comparable transactions to compare it to, or if you're not looking for a full takeover, this implicitly includes the control premium. So it's both a strength and a weakness. There's also analysis called leverage buyout analysis. So essentially, it's looking at, from a financial sponsor point of view, if you lever it up to high amount of reasonable indebtedness, how much could you afford to pay for this company and still meet your goals? And that's it for the first question. There's a little bit of long-winded response. In a real interview, I guess I would probably just say that there's 3 main methodologies. There's DCF, there's trading comparables, and present transaction analysis. And then delve deeper into it if asked or if prompted, because it is a relatively long answer. Now, the second question is, what is the appropriate discount rate to use in DCF analysis? Now, generally, industry uses weighted average cost of capital. So essentially, it looks at how much the cost of capital is to the firm. And it's based on a weighting of both the cost of debt and the cost of equity. And then the cost of debt is the after-tax cost of debt, because interest payments count as expenses and therefore lowers your taxable income. What typically is higher, cost of debt or cost of equity? Typically, cost of equity is higher because the cost of debt has that tax benefit. And also, bondholders get paid before equity holders do, so there would be a bit of additional safety net there. How do I calculate the cost of equity? So there's something called the CAPM model, which looks at how the how the stock moves along with the market portfolio, and it bases that, I use that correlation to calculate a risk premium that's added on to a risk-free rate. There's also multi-factor models, which looks at different factors of the company to figure out how much that cost of equity is. And you can also look at a comparable set of companies that unlever their cost of equity because of the cost of capital for different debt structures, and then back in the cost of equity from that, and then relever to make your cost of capital. How do I calculate the beta for the company? You can use the leveraging and unlevered methodology. You can look at historical correlations to the market. What is the appropriate numerator for revenue multiple? That's a good question. So revenue multiple, I'm guessing, would be something like sales over fixed assets, or depends on the ratio actually. So the key thing is that, well, we'll look at earnings multiples, then is making sure that it's comparing apples to apples. So that's why we look at price to earnings, which is on a levered basis, to EV over EBITDA, which is both, what's the word? A capital structure neutral, so therefore is immune to the effects of leveraging. So that's one way, and the second way, I guess, depends on what the question is asking. That answer was based on if it was asking about the accounting ratios. How would you value a company with negative historical cash flow? So that means that it depends on how you probably project out. So DCF is based on future cash flows, which means that if future cash flows are overall positive, then therefore you would still be willing to pay for that. Historic doesn't really matter as much as the future. That being said, if the future cash flows are negative, then you're essentially paying for a company that's going to continue making losses. You probably wouldn't pay for anything, because if those losses are guaranteed, then as an equity owner, you're going to lose your full stake. As a bondholder, you might get some of your money back, you might not, but nonetheless, from an equity point of view, if there's no, I guess, upside, and at most you'll get zero, then you shouldn't be paying anything for it. That being said, with historical cash flow, if the current earnings were negative, then you can use for example, price to earnings. If EBITDA was also negative, they can't use that either. So therefore, we'll be using the DCF analysis. Next question. When should you value a company using a revenue multiple versus EBITDA? So as mentioned previously, you want to make sure that you're comparing apples to apples. So therefore, you want to use your revenue multiple for something that's to the firm, I believe. And then for EBITDA, probably to EV over EBITDA, for example. That being said, I'm not too sure on this answer, so I'll get back to it and cover it on the part 2 of this series. Two companies are identical in earnings, growth prospects, leverage, returns on capital, and risk. Company is trading at 15 times PE, while the other trades at 10 times PE. Which one would I prefer as an investment? I would prefer the 10 times price to equity one, just because it's cheaper. And that being said, the reason for this is because it's identical, and therefore you're paying less money for a similar quality of asset based on proportion. The size of the company doesn't matter, because if the size is 10 times bigger, then you're paying 10 times more as well. So that's the beauty of multiples. So therefore, 10 times is a cheaper investment, therefore more of a value investment. That's it for now. We'll cover more in part 2, and thank you. Oh, and I guess as a bit of a closing, we wanted to just explain that. So under a general finance interview, there's behavior questions, there's technical questions, and then there's market questions. Behavior questions are more of the typical HR questions of what would you do in case of X, for example. For example, if you had to think back to a time when you had a conflict with a classmate, how do you deal with it? So that's more based on behavior. Technical questions are more based on the technicals of finance, and therefore I can ask you these questions on accounting, on finance, on valuation, so forth and so on. And then there's also market-based questions, which ask you about what's going on in the market, what's going on in the world, price of oil, what's happening to it, where's the S&P index at. That's more based on showing your interest in finance, but more than just knowing, I guess, what the news articles are, but is also understanding what those articles mean. And we'll cover all those in our full series. So therefore, this will be a multi-part process. Hopefully, it'll help you for your interviews. I'm doing this as a prep for mine as well. Thank you. Take care.